Tonight, Bitcoin options traders are quietly making one of the boldest bets we've seen in weeks. While price action may look uncertain on the surface, derivatives markets are telling a deeper story, a story that suggests a potential rebound toward $90,000 could be forming beneath the noise. Right now, Bitcoin is trading near $66,000, down modestly over the past 24 hours. But behind the scenes, positioning in the options market reveals something important. According to on-chain derivatives platform Derive, traders are beginning to structure positions that anticipate a move into the $85,000 to $95,000 range over the coming month. And the key question tonight is this: is the market forming a base? Over the past several weeks, sentiment across crypto has been fragile. Volatility spiked, risk appetite faded. Bitcoin briefly dipped towards 62,000 before rebounding toward the high 68,000 area. Many traders assumed further downside was likely, but data now suggests the tone is shifting. Not aggressively bullish, but cautiously constructive. Dr. Sean Dawson, head of research at Derive, notes that the crypto market is beginning to show early signs of stabilization after weeks of uncertainty. What stands out most is the shift in derivatives positioning. Traders appear to be reducing aggressive downside hedges while still maintaining defined protection. In simple terms, they are no longer preparing for collapse, but they are not abandoning caution either. One of the most telling signals is volatility compression. After a brief spike at the start of February, Bitcoin's implied volatility has settled back into the 50% range. Historically, this level is associated more with consolidation than panic selling. When volatility compresses after a period of fear, it often signals that the market is digesting information and preparing for a directional move. At the same time, the 25 delta skew, a key gauge of option sentiment, has rebounded sharply. Just days ago, skew was deeply negative, around minus 15%, signaling strong demand for downside protection. Now it has moved closer to minus 7%. That shift suggests traders are becoming less aggressively defensive and more balanced in their outlook. Options flows reinforce this cautious optimism. The March 27th expiry currently holds the largest open interest in the Bitcoin options market. Within that expiry, significant call accumulation is concentrated at the $80,000 and $90,000 strike levels. When traders cluster calls at higher strike prices, it signals expectation, or at least preparation for upside movement. Derive interprets this concentration as positioning for a potential recovery into the $85,000 to $95,000 range, particularly if liquidity conditions stabilize. But this is not blind bullishness. Downside protection remains firmly in place. There is substantial put open interest at the $60,000 and $55,000 strikes. That means bears are not expecting a collapse, but they are defining a downside range. The market appears to be bracing for volatility within boundaries rather than capitulation. This structured positioning is critical. It reflects a market transitioning from emotional panic to calculated risk management. And this transition is not happening in isolation. Ethereum derivatives markets show a similar pattern. There is notable call exposure building around the $3,500 strike. At the same time, strong put demand remains at $1,800. This asymmetric setup underscores continued macro uncertainty. Traders are preparing for upside, but hedging against geopolitical risk and delayed capital inflows. Macro conditions remain a powerful influence. Data from Bybit and Blockshows indicate that 1 week at-the-money implied volatility climbed to about 60% after Bitcoin's recent dip and rebound. The front end of the volatility curve is mildly inverted, often a sign that short-term uncertainty remains elevated. Put skew has eased from extreme levels, but is still tilted toward downside protection. Meanwhile, perpetual futures open interest continues to decline. That suggests limited appetite for aggressive leveraged exposure. In other words, traders are positioning, but they are not gambling. The $70,000 psychological level continues to act as resistance. Bitcoin bulls have struggled to reclaim and hold above this threshold for much of the month. As a result, the asset is currently on track for its fifth consecutive monthly decline, something that historically has only occurred a handful of times. Yet, beneath this surface weakness, fundamentals remain supportive. Institutional flows, macro liquidity trends, and ETF behavior all indicate that the broader structure is not breaking down. Instead, the market may be recalibrating. Recent research from Binance reveals that options market hedging has reached its most extreme level since the FTX collapse, and this time there is no comparable fundamental catalyst driving fear. That discrepancy suggests sentiment may be disproportionately negative relative to underlying conditions. Additionally, Bitcoin's recent price behavior has closely tracked high-beta technology stocks. This correlation reflects growing institutional ownership through exchange-traded funds. Many institutional investors treat Bitcoin not purely as digital gold, but as a technology proxy, sensitive to rates, liquidity, and growth expectations.
That brings us to ETF flows. U.S. spot Bitcoin ETFs have recorded net outflows for 4 consecutive months. However, there's a notable shift emerging. The market is currently on a 3-day net inflow streak exceeding $1 billion. On Thursday alone, net inflows totaled over $250 million. BlackRock's IBIT led with substantial creations, alongside strong participation from Bitwise's BITB, even as other funds saw moderate outflows. This tentative re-engagement suggests institutional capital is not exiting the space entirely. Instead, it may be selectively accumulating during weakness. Meanwhile, broader macro conditions continue to shape risk appetite. Treasury yields recently dipped toward 4% on the 10-year before stabilizing. Crude oil benchmarks experienced intraday volatility but ended largely unchanged. Technology stocks remain under pressure, and geopolitical developments, including U.S.-Iran talks, contribute to cautious sentiment. Federal Reserve policy expectations remain a central variable. If macro clarity improves, particularly around interest rates or trade policy, risk assets, including Bitcoin, could benefit from renewed capital flows. Taken together, these data points suggest something subtle but meaningful. The market may be attempting to form a base. Base formation is not explosive, it is not dramatic, it is typically slow, frustrating, and often accompanied by skepticism. Volatility compresses, sentiment improves incrementally. Structured positioning replaces panic-driven trades. That is precisely what derivatives markets appear to be signaling. If Bitcoin can stabilize above the mid-60,000 region and reclaim 70,000 convincingly, the call positioning between 80 and 90,000 may become increasingly relevant. Liquidity could accelerate the move if macro conditions cooperate. However, if macro headwinds intensify or ETF inflows reverse sharply, the protective put positioning at 60,000 and 55,000 suggests traders expect downside to remain contained within defined levels, not cascade into a systemic collapse. This is a market balancing conditional optimism with disciplined risk control. The broader lesson here is that price alone does not tell the full story. Derivatives positioning often reveals sentiment shifts before they become visible in spot markets. Volatility compression and skew normalization typically precede directional expansion. Right now, the options market is not screaming panic, it is whispering preparation. And that preparation appears tilted, carefully toward upside participation. Still, conviction remains cautious. There is no evidence of euphoric leverage returning. Futures open interest remains subdued. Funding rates are not excessively positive. Retail frenzy is absent. This is not a mania phase. It is a recalibration phase. If Bitcoin is indeed forming a base, it will require time, stability, and macro alignment to confirm, but the early signals are emerging. As volatility compresses and structured positioning builds, the stage is being set for the next decisive move. Whether that move carries Bitcoin toward 90,000 or tests the lower protective strikes will depend heavily on liquidity, institutional flows, and global macro developments over the coming weeks. For now, traders appear ready. Ready for recovery, ready for volatility expansion, and ready, above all, to participate, but with protection. That balance may be the clearest sign yet that the market's confidence crisis is evolving into calculated opportunity. And as always in crypto, the derivatives market may be telling us what comes next before the chart does. Stay focused, stay disciplined, and watch the positioning, because beneath the surface, something is